Hello everyone, this is Pammy Jaiswal. In today's video, we are going to discuss about value chain partners with a specific focus on financial sector entities. Why are we discussing this topic on value chain partners? Now, maybe because one of the reason is that top 250 listed entities as per SEBI's mandate will be required to report on BRSR core, and that is also by their value chain partners from financial year 24-25. While this is on a comply or explain basis, but no entity would want its sustainability rating to be degraded just because it's unable to take the BRSR core disclosures from the value chain partners. So it becomes very important to know what is a value chain. Who is a value chain partner? Value chain partner, of course, is the one actor, the one participant. When I say one, of course, there are several participants in a value chain, which helps in creating value for the product or services of an organization. If a company is doing its sustainability reporting, and in doing so, if it uses information and data restricted to its own operations, such sustainable reporting will be incomplete and incorrect. Because when I say that a company is in existence, it's working, it's functioning, it cannot do so without being, without relying on other entities, other, vendors or other supporting staff, or you can say any other specific service provider, either in the upstream or the downstream of the entity, which helps the entity to create, to add value and to help it to provide the required goods and services. And therefore, it's very important that one should also factor the impact created by such value chain partners of the entities which are required to do sustainable reporting. Again, when we talk about sustainability reporting, or you can say the BRSR reporting for the value chain partners, it is important to understand that many a times it can also be a case that the entity, which is a reporting entity, might have a very negligible impact on the environmental front, let's say, coming out of its own operations. Let's say a financial sector entity. It might have a very negligible impact coming out of its own operations. But when you talk about the value chain partners of a financial entity, let's say the borrowers of the financial sector entity, that borrower can use the funds taken by from the financial sector entity into a project which causes serious environmental impact. Hence, that impact is also required to be factored while the sustainability reporting is being made by the financial sector entity. So what is required to be captured, or what is required to be mapped when a sustainable reporting is being done by a value chain partner? So there are three things. First, the impact created, the positive or the negative impacts. Second, the risk posed. And third, the opportunities provided. And for the purpose of reporting, as we move ahead in the discussion, we'll find that the material or significant impact, risk, and opportunities are required to be reported. So let's begin. As we discussed, we'll be moving towards each of these segments. So before that, let's understand that, of course, sustainability practices or the ESG governance, ESG reporting, all of this has gained a lot of importance because adapting and mitigating climate change and inclusive growth and transitioning to sustainable economy, they are like the major global issues in today's world. And hence ESG comes here in to help manage the risk and opportunities in relation to the environmental, social, and governance criteria. It's actually it's a way to measure the responsible investing and lending. If I have to specifically talk about a financial sector entity, it's actually a way to measure how responsibly one is investing and lending by a financial sector entity. It, of course, goes beyond the traditional method of using financial factors. And governance under ESG that demands transparency and accountability for the ESG practices of the entity. Whatever is reported in a sustainability report, and if I talk about in the Indian parlance, let's say the BRSR report, right? Whatever goes into that report, unless that is, let's say, extended to all its partners, to all its value chain actors, which, or you can say, whose activities are very closely related to create an impact in the ESG front, from the entity's perspective, the sustainability reporting will be incomplete. Another very important aspect is that only having the figures, only having the data in the report might not be sufficient. And hence, there is a very crucial need to ensure that whatever information goes into the sustainable reporting is actually backed by some assurance, because that creates credibility of the disclosure, right? Now, if we talk about SEBI introduced the requirement of BRR from financial year 1920. In 2022 May, they constituted the ESG Advisory Committee to make recommendations and to streamline the regulatory framework for ESG disclosures, ESG ratings, and ESG investing. Of the many recommendations that it made, ESG disclosures was a part, and BRSR core requirement was also brought in the frame, specifically for the value chain partners. On 12th July 2023, SEBI brought the requirement to report BRSR core containing the framework for assurance and ESG disclosures for the value chain partners. We all know that, of course, listed entities are very well aware about this concept of BRSR, because they've been the top 1,000 listed entities have been reporting BRR. Thereafter, they were required to come up with BRSR, which is a much elaborate version, much more elaborate version of BRR, containing the essential and the leadership indicators. And of course, it is divided into 3 segments, where the third segment talks about the 9 principles which have been laid down by the National Guidelines on Responsible Business Conduct. Now, BRSR is moving towards a quantitative and standardized disclosure on ESG parameters, which is under BRSR core, to enable comparability across companies, sectors, and time. Not that only, but BRSR core, consisting the set of key performance indicators of the 9 ESG attributes with assurance requirements, have also now been tied to the value chain partners. As we just discussed, SEBI, via LODR Second Amendment 2023, introduced the concept of BRSR core with the requirement of obtaining assurance on BRSR core of the listed entity and its VCP. In July 2023, the BRSR core format was brought, and there was a glide path which the listed entities are required to follow. And in that glide path, the top 250 listed entities will be required to report BRSR core along with reasonable assurance, along with the value chain partners to report on BRSR core. Now, for the value chain partners, on the assurance front, there is a requirement of limited assurance from financial year 25-26. And yes, both the disclosure of BRSR core by value chain partners as well as the assurance requirement is on a comply or explain basis. In fact, this has been a very it's been an evolution, and till now you'll find several changes coming in, like in the meaning of value chain partners also. There have been several discussions by SEBI in its board meeting to narrow the definition of value chain partners for the sake of smoothing or easing out the implementation practices by the listed entities. Now, coming straight to the topic. Who are value chain partners? Value chain partner. The word is, it's a value creating chain. So in the context of a listed entity, when do I say a value is created or a value chain is created? Now, SEBI has given guidance on this. SEBI, via its circular dated 12 July 2023, defined value chain partners partners as the top upstream and downstream partners of a listed entity, cumulatively comprising 75% of its purchases or sales by value, respectively. Which means that when SEBI is talking about reporting by value chain partners, or taking the disclosures on sustainability by value chain partners, it is very clear that not all value chain partners will have to be reporting on the sustainability practices, because of course when we talk about reporting on sustainability practices, the ones which are significant, the ones which create a significant impact, a material impact, are the ones whose reporting is actually required. So it was very clear from SEBI's front that the value chain partners, that is top upstream and downstream partners, cumulatively comprising 75% of its purchases or sales by value, will be included in a value chain partner. Now, SEBI also gave in its guidance note, it has clearly defined a value chain partner to say that an organization's value chain encompasses the full range of an organization's upstream and downstream activities that convert input into output by adding value. So it's very clear that we are not going only, let's say, one level up, or we are going one level down. It is the full range of organizations' upstream and downstream activities that convert input into output by adding value. It includes entities with which the organization has a direct or indirect business relationship. And that's where we make it extremely broad. We are talking about both direct as well as indirect business relationship, and which either supplies products or services that contribute to the organization's own products or services, or receive products or services from the organization. So clearly, the guidance given by SEBI when it was talking about value chain partners is that value chain is not only the immediate upstream and downstream partners. It is actually the entire activity chain for an entity when it starts its operations, before it starts the operations, and how value is added so as to enable it to have its operations and finally turn the turn the inputs into output and finally give it to the customers. Now, SEBI in its board meeting dated 18 December 24 revised the definition of value chain partner to say value chain shall encompass the upstream and downstream partners of a listed entity, individually comprising 2% or more of the listed entity's purchases and sales by value. So this particular step, which was taken by SEBI, while it has not been notified as of now, but this particular step was with the sole intention of allowing listed entities to actually gather the information, or have their value chain partners to do this reporting, to take reporting from them on BRSR code. Because if we widen the meaning or widen the ambit of value chain partners for reporting purposes, then we might first of all lose on what's material, what's significant, and of course there are several practical implementation difficulties which an entity would face on collecting such information from its value chain partners. Next, let's come to who are value chain partners under the international parlance. International guidance on this concept has been, it's all across, several standards internationally, and several guidances internationally are there to mean or to explain what a value chain partner is. If I have to talk about the value chain, this concept was first introduced by a Harvard Business School professor, Michael Porter, in his book in 1985. Again, where the description is very much alike what SEBI said: full range of activities which are requiring to bring a product or service from conception through different phases of production, distribution to consumers, and final disposal after use. So, sorry. So this definition here again makes it very, very wide on who all are construed as a value chain partner. The Harvard Business School explains value chain as various business activities and processes involved in creating a product or performing a service. A value chain consists of multiple stages of a product or service life cycle, including research and development, sales, and everything in between. Talking about the GRI standards, where the Global Sustainability Standards Board defined value chain as a range of activities carried out by the organization and by entities upstream and downstream from the organization to bring the organization's products or services from their conception to their end use. Further, we also have guidance from the European Sustainability Reporting Standards, read with the EFRAG Implementation Guidance 2, which is a guidance on sustainability reporting. It states a value chain encompasses the activities, resources, and relationship that undertaking uses and relies on to create its products or services from conception to delivery, consumption, and end of life. Relevant activities, resources, and relationships include what all? Those in the undertaking's own operations, such as human resources, those along its supply, marketing, and the financing, geographical, geopolitical, and regulatory environments in which the undertaking operates. Not only this, but recommendations of the TCFD also defines value chain as upstream and downstream life cycle of a product, process, or service, including material sourcing, production, consumption, and disposal or recycling. Upstream activities include operations that relate to the initial stages of producing a good or service, that is material sourcing, material processing, supplier activities, or downstream activities include operations that relate to processing the materials into finished product, delivering it to the end user, that is like transportation, distribution, and consumption. It's also important to understand the meaning of business relationship here. Now, business relationship, if you look at the GRI standards, it states relationship that the organization has with business partners, with entities in its value chain, including those beyond the first tier, the first tier. That means I'm not looking only at the immediate upward and downward business relationship. That means I'm not only looking at the direct business relationships. I am looking at both direct and indirect, and in fact, beyond the first tier of relationship or business relationship that I have with these entities or actors, and with any other entities directly linked to its operations, products, or services. After having discussed the value chain partner concept in the international scenario, let's talk about some of the international disclosure requirements when it comes to value chain partners. So TNFD, which is the Task Force on Nature-Related Financial Disclosures, specifically considers its, says that an entity should consider its exposure to climate-related risk and opportunities, and it should also consider the exposure of its value chain. So hence, under the TNFD guidance, one needs to report on the value chain partners as well. International Sustainability Standards Board under IFRS S1 and IFRS S2 also talks about value chain partner reporting to state organizations to disclose material information about sustainability related risks and opportunities that could reasonably be expected to affect an organization's prospects, including the concentrated parts in the value chain, which means when I say concentrated parts, we'll also discuss about this in detail, that whether reporting by all value chain partners is the intent of law, is the intent of the sustainability reporting concept. Of course, the answer is no. And that's why here also under the ISSB, you'll find that it talks about reporting on the concentrated parts in the value chain. Under the CDP questionnaire, it also asks organizations if they have mapped their value chain and the commodities they produce and or source an introduction module to demonstrate the extent of visibility they have into their value chain. In the GRI, of course, organizations need to identify impacts all across their activities and business relationships, including with all entities in its value chain. Again, coming to European Sustainability Reporting Standards and guidance on by EFRAG, the reporting undertaking should provide information on the material impacts, risks, and opportunities connected with the undertaking through its direct and indirect business relationship in the upstream and or the downstream value chain. Next, we talk about the greenhouse gas protocol, which again provides for the minimum boundaries for each value chain when it comes to disclosure on emission standards. Now coming to the next segment, again, a very, very significant segment for today's video that we are doing. Value chain partners for financial institutions. Now, does financial institutions have value chain partners? Now, after having discussed the meaning of value chain partners, it becomes clear that yes, because of the various business relationships it has with different entities and individuals, it will surely have a value. It will surely have value chain partners. Financial institutions' value chain relies upon several actors like people, capital, intangibles like license, technology, borrowers, investees, etc., support service providers. In the opinion of the European Banking Authority on the draft European Sustainability Reporting Standards, a core principle in the sustainability reporting framework and from European Banking Authority's perspective, because the definition of value chain is so clear, it is very, very much implementable for credit institutions. As a part of financing and asset management activities, credit institutions hold stakes in investee companies and they lend money to borrowing companies. Hence, investee and borrowing companies may be part of its value chain. So, are there clear-cut guidance on who all will be covered under value chain partner for financial institutions? We look at the exposure draft on, by GRI sector standard project for financial services, which indicates that banking products such as general purpose or corporate loans or project finance support institutional customers' activities. It can lead to several impacts. Because when a financial institution is granting loan or making investment, the entity which is on the receiving front it has the power to make several impacts, several types of impacts, because it follows its own practices. It has its own end use of the amount which it has taken from the financial institution, and hence it can lead to various impacts. Now, the lender may be giving a asset-based loan or a loan with a specific end use or give a general purpose loan. Now, in the case of the former, lender will have to consider the negative impact of the funded project or asset as the end use of the loan is circumscribed. And in case of a general purpose loan, lenders will have to consider the negative impact of the general activities of the borrowers. If we also refer to the IFRS exposure draft on climate-related disclosures on financed and facilitated emissions, financial institutions, including commercial banks, investment banks, asset managers, and insurance companies, are to disclose the extent of their investment, lending, and underwriting activity associated with sustainability-related matters. Absolute greenhouse gas emissions that banks and investors finance through their loans and investments are often referred to as financed emissions, which means that if I am lending to an entity and that entity is using that money for a project which has, maybe severe greenhouse gas emissions. So when I am considering my sustainability practices as a financial institution, I will have to map the emissions that the banks, that we have found that the borrower has actually emitted. And this is actually known as a financed emission. And for this, guidance can be taken from, the TNFD, which is the Identification Assessment of Nature-Related Issues, which has given a LEAP approach for measuring such concerns. Next, we have the recommendations of the TCFD, which talks about most impacts and dependencies for a financial institution are generated through their portfolios, that is their financial activities, rather than their direct operations. TNFD recommends financial institutions to disclose according to the TNFD core global metrics for their own operations. Also, it refers to the TNFD guidance for financial metrics for quantifying their nature-related dependencies, impacts, risk, and opportunities. Now, if I talk about some of the participants, and let's see if they are also considered and could be considered as a value chain partner. So depositors, yes. If they are upstream or downstream, we'll say upstream. Why? Because, of course, for a financial institution, deposits are received from savers of money, are channelized to the borrowers since they are fund providers. Hence, in the value chain, if I say depositors, do they create an impact? Yes, they do. Because they are creating value for the financial institution by channelizing their funds into this entity. Borrowers, both retail and corporate, yes, they are included down and they are downstream value chain partners. And reason why they should be included is we just discussed, because borrowers being customers are explicitly included in the downstream value chain because they create impact in the environment by using the funds taken from the financial institution. The support staff facilitating technology services, again, yes, in the upstream value chain, because they are adding value in the form of efficiency, speed, and security. And they ensure timely and seamless delivery of services and facilitate final distribution to the final customers of a financial institution. Employees of the financial institution, again, yes. Investee companies. Now, whether they are included in the value chain, it is conditional, because you have to look at several factors, like what is the level, what is the extent of investment, what is the level of influence, is there any manner of deciding on the policy decisions, or decision-making process is taken by the financial institution, whether they have a say in that or not, all of that factors. Recovery agents and ATM service providers, again, yes, will be considered as value chain partner for a financial institution. Coming to the second last segment of today's video, whether all value chain partners are to be considered for reporting. Answer is a clear no. While when you are identifying your value chain partners, you have to look at the meaning of value chain partners. But why are you actually identifying value chain partners? Because you have to ensure that the sustainability practices you follow as a financial institution or as a listed entity is also followed by your value chain partners. Which value chain partners? All value chain partners? Answer is no. Because we have to look at, amongst all the value chain partners, who are those which are creating material impact. They are the ones who create the maximum impact, right? And that is where we'll find, even in the international standards, they've all stressed upon reporting by material value chain partners. So first, talking about the exposure draft and GRI, it says, it outlines the topics that are likely to be material for organizations in the banking sector have to have a merit of reporting. For each likely material topic, the sector's most significant impacts are described and disclosed. In the draft ESRS1, it captures the need to include VCPs in the sustainability reporting with the clear intent of involving only the material value chain partners. In the opinion of the European Banking Authority draft, we see that EBA also supports the clarification of EFRAG that entity does not have to report on all actors of value chain, and agrees that only material value chain information of actors should be included. Next, coming to the ESRS Set 1 guidelines, it says include information on material impacts, risk and opportunities connected with the undertaking through its direct-indirect business relationship in the upstream or downstream chain, following the outcome of its due diligence process and its materiality assessment in accordance with any specific requirement related to the value chain in other ESRS. So here again, ESRS provides a guidance on how to assess if a particular value chain partner is having a material impact on the reporting entity's operations. Next, material value chain information is to be included because it is necessary to allow users of sustainability statements to understand the undertaking's material impacts and produce a set of information that meets the qualitative characteristics of information. Again, if I have to talk about the value chain aspect from an investee perspective, that means if I'm a financial institution and I've made investments, right? Will I consider all my investees a part of value chain? We have to see if the financial institution is able to influence or control the investee. Is there, what is the extent of investment? Is there, any involvement in the decision-making process? Because in the absence of these, still considering any other investment as a part of value chain will not serve the actual meaning of a value chain partner. I mean, it should not be included in the meaning of a value chain partner. In case of investees being joint ventures and associates, EBA supports that only material value chain information of JVs and should be given in the value chain, and should include other bases. This assessment should be based on other factors also apart from the equity investments held. IFRAG implementation guidance states that information on material impact, risk, and opportunities connected to the undertaking's upstream and downstream value chain is to be considered for sustainability reporting. Coming to almost the last part of the video, what could be the concerns and what should be the suitable approaches when it comes to sustainability reporting of value chain? Because first of all, identifying your value chain partners, then understanding amongst all the value chain partners, which value chain partner is a material value chain partner. So all of this will involve collection of lot of data, identifying their roles, understanding their relationship with the business, and all of this requires a unified, a standardized approach by the entities. Of course, the standardized approach will be different from one industry to the another. But if I talk about the industry-specific approach or sector-specific approach, that is likely to be the same. So implementation guidance on the TCFD, it provides a manner to calculate GHG emissions for financial institutions in case of investment, project finance, motor vehicle loans, etc. So there one can get some guidance on how to calculate the emissions from the financed emissions, etc. of a financial institution. Again, the EBA has, in its comment letter submitted to IFRAG, stated that the data quality of that we collect from the value chain, it will have a very high impact if what we are collecting as data from the value chain partners is not correct or it lacks quality. And hence, if there is no sufficient guidance and practical examples on the application of the definition of value chain, a wide range of business models, including the institutions operating in the financial sector, will face difficulty. Under the ISSB framework, it states that an entity shall use all reasonable, supportable information that is available to the entity at the reporting date without undue cost or effort to determine the scope of its value chain, including its breadth and composition in relation to each of those sustainability-linked risks and opportunities. Further, in the EBA's ESRS draft, it states that on way through which the undertaking can demonstrate reasonable effort in collecting data from actors in its value chain is by using and increasing the leverage over them. That is through collaboration with other companies, stakeholders, if they help to do so. And of course, as we just discussed some time back, the LEAP approach by the TNFD, it is designed as an iterative and repeatable process across business locations and business lines for corporates and across investment portfolios and asset classes for financial institutions. It is in line with the enterprise risk management process and reporting and disclosure cycles. Last, we're talking about one such guidance by the International Task Force on Nature-related Financial Disclosures. For financial institutions, it provides a very specific guidance on the assessment and reporting by the financial institutions on several parameters when it talks about impact assessment, like strategy, impact, risk and impact management, metrics and targets, etc. It also provides additional guidance on core global disclosure metrics, including nature positive and vulnerability, etc. So with this, would like to conclude today's video. But yes, this topic, the value chain partners, and specifically with focus on financial entities, is very significant. And given the fact that, let's say, the top 250 listed entities, amongst which there are financial entities also, they must have started collecting data so as to be able to report the BRSR code by the value chain partners. Thank you for listening, and we'd love to have feedback on this video.